Howdy, folks. Welcome to Liberty Call for Wednesday, July 27th, 2022. Hope everybody's having a great day out there. I'm watching my Astros play like dog poo on TV. It is quite irritating that they continue to play down to their competition. They've lost the first two games to Oakland, and they're down 2-0 in the fourth right now. And it's quite irritating as a baseball fan. So anyways, well, in better news, the stock market took the rate increase today in stride, and the market really rallied after the announcement at, I guess, around noon here Mountain Time. So let's go ahead and jump in and take a look and see how the markets finished out for the day. The Dow Jones was up 1.37%, closed at 32,197, up over 400 points. The S&P 500 up 2.62%. Closed at 4023. Nasdaq up 4.06%. Wow. Closed at 12,032. Small caps are up 2.5%. The VIX pulled back 5.87%. It's currently sitting at 23.24. Moving over to the other exchanges here in the Americas, the Canada was up 1.49, Brazil up 1.67, Mexico up 0.36. Jumping across the Atlantic, Germany up 0.53, UK up 0.57, France up 0.75, Euro stocks up 0.91, Netherlands was up 1.03%, Spain up 0.68%. Who's this? Italy up 1.52, Switzerland down 0.41, and Portugal up 1.96. Over in Russia, the MOEX was up 0.17, and the RTSI was up 1.58%. Head over to the Asian markets. Japan was up 0.22, Australia up 0.23, New Zealand was basically flat, up 0.01%. Head over to the Chinese markets. The Shanghai was flat at down 0.05. The SESE component, basically the same, down 0.07. The China A50 down 1.03%. DJ Shanghai down 0.13. Hang Seng down 1.13%. And the Taiwan weighted came in up 0.78%. So for most of the day, things look pretty good across the board. Obviously, we had a pretty significant jump here at the last couple hours of the market here. Let's go ahead and look at the daily chart for the Dow. And you can see right here, right at 1230, huge spike in the Dow Jones. So 2:30 would be 12:30 my time. So you see this huge spike where the Fed finally announced that they were raising rates 0.75%, and we had a really nice jump there. So it not surprising. I mean, they've been telegraphing this for quite a while. So if anyone was caught off guard by this, you weren't paying attention, obviously. So. All right, well, let's go ahead and read through today's market recap. S&P 500 rallies as Powell says Fed could cool rate hikes. Nasdaq soars 4%. The S&P 500 jumped Wednesday as the Federal Reserve Chairman Jerome Powell signaled that the Fed could slow the pace of rate hikes, while tech rallied after quarterly results from Alphabet and Microsoft weren't as bad as many had feared. Following the Fed's 0.75% rate hike on Wednesday, Powell teed up the idea of another unusually large, in quotes, rate hike in September, but said that further tightening could push the Fed to slow the pace of rate hikes to assess the impact on inflation and the economy. Yeah, you wouldn't want to get those rates or that rate up too quickly to slow things down now. I mean, most of us would like to see the inflation go away sooner than later. Quote, as the stance of monetary supply tightens further, it will likely become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation, Powell said. The two-year Treasury yield sensitive to Fed rate hikes slipped sharply following the remarks as investors appeared to be pricing in the prospects of a pause or easing pace of rate hikes. Tech, meanwhile, added to recent gains following a rally in Alphabet and Microsoft. Alphabet reported earnings and revenue that fell short of estimates, but were better than feared, driven by strength in its search business, sending its shares more than 8% higher. Quote, Google's better than feared results continued in the face of an uncertain macro with search upside offset by slight YouTube, cloud, and other revenue softness, end quote, RBC said in a note. Microsoft also reported a miss on both the top and bottom lines, driven largely by a stronger dollar and the impact of China lockdowns, Wedbush said, though it added that the tech giant's growth story remains intact as its shares were up more than 6%. Microsoft's growth story is, quote, cloud and core Azure growth, which was healthy this quarter and appears to have momentum into 2023 despite economic headwinds, end quote, Wedbush added. Semiconductor stocks were also in favor as Texas Instruments' better than expected quarterly results and guidance improved sentiment on chip stocks. NVIDIA, Monolith Power Systems, and On Semiconductor Corporation were among the biggest gainers. In other news, PayPal jumped more than 12% as activist investor Elliott Management reportedly took a stake amid plans to push the company to speed up its cost-cutting efforts. So, even when some of these big companies miss on their quarterly reports, stocks still go up. So I guess people were really in a mood to jump back into the market and push those prices back up a little bit. All right. Next article here is the market getting ahead of itself by pricing in rate cuts. Yeah, again, we don't even have inflation under control, and they're already talking about, reducing rates and how that's going to be, really great for us at some point in the future. All right, let's dive into this. As we showed last night, a huge gap has opened between what the Fed forecasts it will do, at least until the Fed joins the ECB in admitting it has zero clue what happens next and does away with forward guidance completely, and what the market expects will happen. As a reminder, after today's 75 basis point rate hike, the Fed is widely expected to hike 50 basis points in September before slowing further to 25 basis point hikes in November and December, leaving the Fed funds rate at 3.25% to 3.5% in December, about 100 basis points above neutral. At this point, things get complicated, and as we discussed overnight, opinions diverged dramatically between J.P. Morgan, which sees rates being cut, and Morgan Stanley and Goldman Sachs, which sees sticky high rates remaining for a while, if not rising, at least until inflation is defeated. What about the market? Well, according to the OIS, rates peak around 3.5% to 3.75% in February before the Fed's starting to cut rates in Q1 2023 as markets start to incorporate ongoing growth concerns and the impact of tighter policy, with markets implying a terminal rate of 2.75 to 3% in November of 2023. Meanwhile, as shown in the dot plot below, the median in the Fed's June SEPs sees the terminal rate between 3.75 and 4% in 2023 before cutting to 3.25 to 3.5 in 2024. In other words, someone will be very wrong, either the Fed or the markets. And while it is a safe bet that the Fed is always wrong about everything, because it is, DB's Jim Reed plays devil's advocate and suggests that it is the market that is too sanguine about the Fed's terminal rate, anticipating a peak around 3.36% by the December meeting before pricing in the possibility of cuts in Q1 of 2023. Reed's first brings attention to a note published by a member of his research team, available to ProSubs, which looks at how accurate 12-month Treasury yields have been at predicting the path of the Fed back to 1960. T-bills tend to underprice the Fed tightening during hiking cycles and overprice how tight policy will be during cutting cycles. However, the analysis suggested that when inflation was above 4%, the market more aggressively underpriced the Fed. In lower inflation environments, markets are too hawkish in advance, which has been the case much of the last 20 years. Which begs the question, are markets simply extrapolating what they know from the recent past? A second reason why markets may be getting ahead of themselves was also addressed by DB's economists, argues that the Fed cannot reverse course and start cutting rates next year unless inflation materially slows. Unemployment moves above 6%, and the Fed reaction function starts to take labor slack into consideration, contrary to their recent one-track focus on inflation. While there are more details in the full note, in short, the Deutsche Bank House view remains remains a terminal rate of 4.1% reached in December, and with difficulties thereafter in cutting rates, of course. Deutsche Bank also expects a strong recession next year, so it's not likely those difficulties will be insurmountable. All this was largely captured by Bill Ackman's tweet yesterday morning discussing the reflexivity of the Fed's rate cut decision, which the market is starting to front run, thus easing financial conditions and making rate cuts less likely, since the Fed needs to contain inflation first and foremost. Of course, Ackman's complaint is very well known, just as it is known that Ackman is talking his book. What is less known are the growing structural limitations on the bond market, which have resulted from ongoing liquidity drain by the Fed, which prompted Barclays repo market guru Jason Abate to join Bank of America's former New York Fed guru Mark Cabana in calling for an early end to QT. We will discuss that particular angle in a subsequent post. So yeah, it is kind of interesting that, and this was going on before rates started increasing a couple months ago, or a few months ago, back in, I think, March. They were already talking about lowering rates sooner than later. And it's like, wait a minute, we haven't even, tackled the problem that we're raising rates for right now. And you're already, looking, you're already, counting your chickens well before they've already hatched, or even late at this point. So, anyways, it is a little aggravating to see this. So, all right, next article has to do with state of the economy. Shopify cuts jobs, joining Netflix and Apple in Slowdown, and this is a running list of things. So it is quite long, so I'm only going to read through a little bit of it. With recession fears mounting and inflation, the war in Ukraine, and a lingering pandemic taking toll, many tech companies are rethinking their staffing needs, with some of them instituting hiring freezes, rescinding offers, and making rounds of layoffs. On Tuesday, Shopify announced that it cut 10% of its workforce, joining dozens of others in pulling back on jobs. Here's a look at the companies tapping the brakes. Alphabet, Google's parent company, has been decelerating its recruiting efforts. Chief Executive Officer Sundar Pichai told employees this month that although the business had added 10,000 Googlers in the second quarter, it will be slowing the pace of hiring for the rest of the year and prioritizing engineering and technical talent. Quote, like all companies, we're not immune to economic headwinds, he said. The hiring pause is part of the slowdown, Google said. To enable teams to prioritize their roles and hiring plans for the rest of the year, it had nearly 164,000 employees at the end of March. Amazon said in March that it was overstaffed after ramping up during the pandemic and needed to cut back. Quote, as the variant subsided in the second half of the quarter and employees returned from leave, we quickly transitioned from being understaffed to being overstaffed, resulting in lower productivity. Chief Officer Brian Olsavsky said. Amazon is subleasing some warehouse space and has paused developments of facilities meant for office workers, saying it needs more time to figure out how much space employees will require for hybrid work. The company has 1.6 million workers as of March, making it the biggest employer in the tech world. Apple Inc. is planning on slowing and spending some of its visions next year to cope with the potential economic slump, according to people familiar with the matter, but it's not company-wide. And the iPhone maker is still moving forward with an aggressive product release schedule. Apple had 154,000 employees in September when it last fiscal year ended. All right, and I'll run through some of these a little quicker. Carvana laid off 2,500 people in May, about 12% of its workforce. Coinbase Global was cutting 18% of its staff in June. Compass Inc., a real estate brokerage platform, eliminated 450 positions, about 10% of its staff. Gemini Trustco, a cryptocurrency exchange founded by Bitcoin billionaires Cameron and Tyler Winklevoss, announced a 10% staff reduction last month in June. GoPuff, a grocery delivery app, laying off 10%. Lyft Inc. told employees it was reining in hiring in May after its stock dropped precipitously. The company went further on July 20th, announcing plans to shutter its car rental business and cut about 60 jobs. Lyft had about 4,500 employees in 2021. So Meta Platforms said plans to slash plans to hire engineers by at least 30%. And they had 77,000 employees as of last March. Microsoft told workers in May that was slowing down hiring in the Windows, Office, and Teams groups as it braces for economic volatility. The company had 181,000 employees in 2021. Netflix, the streaming giant, they had a loss. In April, began scaling back, then cut 150 employees in May and 300 in June. Last quarter, it reported $70 million in expenses from severance and shed an additional 970,000 subscribers. Netflix had 11,300 employees in 2021. All right, that's about that. There's quite a few more here. You're welcome to read through this. The article is linked in the show notes. All righty, last article here has to do with retirement, and it may be later than sooner for a lot of folks. Plan for a longer life and prepare to work longer. So, the age of retirement has crept higher in the past 3 decades, and Americans can expect to work even longer in the future. The average reported retirement age has risen to 61 today, up from 57 in 1991. For those who have not yet retired, their target date for retirement has also increased to age 66, up from 60 in 1995, according to Gallup's latest annual economy and personal finance survey. The findings come as retirees and pre-retirees are looking ahead to longer lifespans, trying to figure out how to pay for them as medical and housing costs escalate amid volatile financial markets. Quote, to a large degree, this reflects the reality of the financial demands of retirement and eligibility for Social Security creeping upwards, end quote, said Jeff Jones, Gallup senior editor. Changes to Social Security payouts enacted in the 1980s are affecting decisions for workers nearing retirement age, and they provide incentives for people to stay employed longer to maximize their monthly benefits after they retire. Those born after 1960 are not eligible for Social Security benefits until age 67. Retirees are eligible for reduced benefits starting at age 62. Quote, with longer lifespans, people in the past retiring at age 65 might have had to save to live 10 years, but now people have to save to live another 20 or 30 years, end quote, Jones said. Quote, right now we have short-term inflation, but there's long-term inflation issues after decisions that affecting decisions as well. Healthcare and housing are long-term inflationary costs that retirees have to deal with. Those items cost less than the past, Jones said. According to a recent AgeWave report, the top financial worry in retirement in the U.S. was the cost of healthcare and long-term care. Only 22% of U.S. retirees have budgeted for their health and long-term care expenses, and 2/3 of U.S. pre-retirees say they have no idea what their health and long-term care costs may be in retirement. Additionally, a study by Allianz Life found that the majority of Americans say their income is not keeping up with rising expenses. Fewer millennials say they have an effective financial plan in place to help address the rising costs of living, while Generation X is concerned about their income keeping pace with rising expenses. The majority of baby boomers worry that they may not be able to afford the lifestyle they want in retirement because of the increased costs of living, Allianz found. Even as both the expected and actual retirement ages have crept higher, Gallup said it has consistently found that the ages don't match. Retirees' reported retirement age has been about 5 years younger than non-retirees' expected retirement age. This could largely reflect the reality that many current retirees were able to retire at a younger age and get full Social Security benefits than today's workers will be able to. Based on the nature of the study, Gallup's findings could not explain the discrepancy between actual retirement ages and expectations, Jones said. Quote, we're taking a snapshot in time of 2 groups. It doesn't really answer the question well because we're not interviewing the same person at multiple points in their life and finding out the reasons why they did what they did, Jones said. Among Americans nearing or past the traditional retirement age or those between the ages of 55 and 74, significantly fewer people are retired now than was the case for people in the same age group at the start of the 21st century, Gallup found. Quote, I expect these trends to continue and expect to see ages continue to creep up. I don't know if the 2 lines will ever converge at the same point where people correctly predict the age they will actually retire, but we expect to see both ages move up, Jones said. So yeah, that is probably the biggest factor. If you're going to work for 30, 40, 50 years, and then potentially be retired for another 20 or 30, or even 40 if you live past 100, you really need to plan out that far in advance, not just wing it. And anyways, so, all right, well, that's everything I had for today. A little bit of a quicker quicker read through. And if anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. And I'll be back tomorrow with Thursday's Liberty Call. And the Astros scored a run while I was rambling on for the last 20 minutes. So it's now 2-1, bottom of the fifth, runner on first, one out, and Machine is up at bat. So hopefully the Astros can pull it out and not get swept today, but I don't have a lot of hopes. Like I said earlier, they seem to play down to their competition. They kick the Yankees' butts, but can't do crap against the lowly Athletics, which is just shameful. So anyways, hope everyone has a great night, and I'll talk to you later. Bye.